In this video, we will try to learn more about trends. You may agree that a strong trending behavior is not necessarily obvious by visually looking at the chart. Okay, so let's plot the lagged returns. Now it should be more clear. We now have some autocorrelation in our returns. It means that current returns somewhat depend on past returns. And by plotting a line, we can see that there is a positive correlation. But how is this achieved? In a loop, we create a new normally distributed return at each step, and then add a fraction of the previous return, determined by the constant g. So a new return always has a tendency to go in the same direction as the old return. However, if the previous return had, for example, a small positive value, and the new return a large negative one, then the direction would change. Again, note that prices going up is not a trend. Rather, positive autocorrelation results in trends. But positive autocorrelation doesn't always mean we have an uptrend. It can also mean that prices are trending down. What autocorrelation is telling us is that we have some predictability in our series. But is it actually possible to successfully trade it? Think for a minute about how this could be done. Now let's build our first backtest on those seemingly random-looking, but autocorrelated data we just generated. This backtest produces a truly impressive-looking result. Looking at the code, you may be wondering how we could run a whole backtest with one little line, and what's going on in it. There are no loops, no entries, no exits. Is this really a backtest? Backtests come in many shapes, from simple exploratory ones, which we will learn about next, all the way to highly complex ones, with hundreds of thousands of lines of code that take into account portfolio optimization and market microstructure. Writing backtests in the way we see here is a powerful exploration tool, and it is called vectorizing. By adding, subtracting or multiplying vectors, we can speed up the backtesting process, often by orders of magnitude. Down the track, we will dive deeper into the subject, which is an essential skill in the search for micro-alphas. In the code, we've calculated the sign of the current returns and multiplied it by the next period's return, by shifting the return series 1 to the left. So, if our current return is negative, which means signal equals -1, we predict the next return to be negative as well, due to autocorrelation. If that's true, our return will be positive, or negative, if the signs don't match. Once we have produced a series of returns, we can now sum them up with a cumulative sum, CumSum. This will give us a profit and loss or P&L curve which is non-compounding. In other words, profits from the strategy are not reinvested. Plotting P&L curves this way makes them easier to compare, because compounded P&Ls in backtests can sometimes show unrealistic and inflated exponential growth, which makes the comparison more difficult. That was all for this video.